So for my report, I've decided to analyze the Bank of Montreal, mostly given the recent banking crisis we've seen in the US. I thought it would be interesting to analyze a bank and see whether or not the earnings have been affected by the situation. So the Bank of Montreal is the eighth largest bank in North America. It's headquartered in Montreal, but also has a significant amount of business dealings in the US. It represents around 38%, 36% of its total earnings, with 1% being the rest of the world and a good 62% being Canada. So out of the Canadian banks, it's probably one of the largest ones in the US. It's got the second largest presence actually after Toronto Dominion. It's divided into three business segments. So you have BMO Commercial and Personal Banking, BMO Wealth Management, and BMO Capital Markets. Each segment does a significant chunk of what a bank typically does. So there's the investment firm and insurance with BMO Wealth Management. There's regular banking and insurance with BMO Commercial Banking. That's the largest segment. And there's investment banking with BMO Capital Markets. So the corporate strategy is to first and foremost deliver outstanding customer service, develop a corporate culture that is favorable for employees, embrace new technologies as many banks have been doing, and contribute to the transition towards global net zero. But the most interesting one for this analysis in particular is going to be the objective of positioning yourself as a market leader in terms of risk management for banks. So as part of our macro economic factors that I've analyzed, you've got first and foremost, you've got gross domestic product. So historically in Canada, GDP has grown at 3.1% annually. Growth year for 2023 is forecasted at 0.5% and 1.5% in 2024, and it should revert back to about the average thereafter. Interest rates have, as we all know, increased tremendously in the last year from 0.25% to 4.5% currently. This is particularly difficult for banks as the classic business model for a bank is to take in deposits and make loans out of them. So there's a mismatch typically between a bank's liabilities and its assets uh, in terms of the time frame and their maturity. So a bank is going to take short-term deposits to make long-term loans out of them. So this means deposits will reset faster in terms of interest rates than the loans. So when interest rates increase, this reduces the spread between the interest rate that the bank can capitalize on. So this is very bad for banks in terms of their earning potential. However, once interest rates decrease once again, then this is actually really good news for banks, and their earnings actually shot out through the roof. And this should happen sometime within 2024 if inflation continues to decrease as we've seen right now. The last factor that's major for banks right now, especially BMO, is inflation. So inflation in Canada is targeted at 2% annually on average. But right now, last year, it's been closer to 7%. However, it's been decreasing this year so far to 5%, around 5%. The only point to note here is that over the last 2 years, projections on inflation have been notoriously wrong. So we've consistently said that, for example, in 2022, inflation would reach around 3%, whereas it's actually been closer to 7%. So there's no telling where inflation is actually going to go. And the decrease in interest rate that we're projecting is very contingent on a decrease in inflation. So this brings a lot of uncertainty in the market, and this is reflected um, in the current banking crisis. So the other major factor to consider is the current banking crisis in the US. So a few weeks ago, Silicon Valley Bank, First Republic, and Silvergate all ran into trouble, with some of them actually defaulting and having the US government needing to step in and bail them out. The last time this happened for major banks, it was around 2008. And as at the aftermath of the crisis, uh, Basel III, the Basel Accord, Basel III was enacted to increase capital requirements for banks around the world. So this meant that banks couldn't do, couldn't take as much risk, and were much more restricted in their growth and their activities. So this has certainly affected the valuation for banks at the time. However, this time I would argue that this is only temporary. So the setbacks that banks have seen and the lower bank stocks we're experiencing right now should be temporary. There's no reason, in my view, why regulations around banks should change just because Silicon Valley Bank defaulted, for example. I think most banks are actually pretty stable right now, especially for Canadian banks and especially BMO because of its current Tier 1 capital ratios. So, with this view in mind, this would suggest that banks are currently selling at a discount, and investors should or could capitalize on this market inefficiency. So the accounting analysis is mainly based on the difference in accounting um, rules for banks. So first of all, banks are required to provide loss provisions. So they need on their financial statements to have an item on their income statement providing provisions for credit losses, and this provides a lot of room for earnings management. So a bank that is more conservative will provide higher credit losses provision, and this would decrease their earnings, and they could play around with that each year to smooth out their earnings. The second interesting part for banks is the mark to market part of their balance sheet. So every year their asset and their equity and their debt is also mark to market. So most of it can be reflected in market prices. So the valuation is not really historical value. It's more the current market value. That's what the balance sheet represents. So this means that for book value, for example, price to book is a particularly interesting multiple to analyze for banks in general. And the last one is that banks are actually, because of their activity, extremely levered, but we shouldn't see that as a red flag necessarily. Rather, we should think of that for a bank as more of a raw material. So a bank is going to take on a lot of deposits, increasing its debt, and this is going to be repackaged eventually into a loan on which the bank will earn a fee, an interest fee. So for the financial analysis, I've completed a modified DuPont analysis, taking out the interest burden because of the reality of a bank's business model. And so we focus mainly on profit margin, equity multiples, asset turnover, and tax burden. We see that on average, BMO, because of its um, proclivity towards risk management, has consistently lower return on equity, except for 2022. And this is due mainly on the financial statements to the outsized increase in trading revenue. It actually increased by 26 times compared to last year. So last year was around 300 million, and now it's been 8 point something billion for 2022. And this has really shut off their profit margins, which has affected the return on equity. But other than that, we can see that most banks are actually pretty good substitutes for one another in terms of their financial ratios. They are fairly close in in all of these in all of the ratios presented. The other interesting part of the financial analysis is with the net interest margin. So that's a really important measure of performance for large banks. Essentially, it shows the difference between interest received and interest paid divided by the bank's total assets. So it's a measure of how efficiently a bank can use its assets to generate interest returns. And we can see that it's been decreasing for BMO over the past 5 years, and especially over the past 3 years. But so it's been the same thing for the average of Canadian banks. And this is also completely opposite to the trend we've been seeing with treasury yield. So as interest rates have increased, all of the interest margins for all Canadian banks have decreased. And this sort of explains, it goes back to the idea of the mismatch between maturity of assets and liabilities for banks in general. Finally, prospective analysis. So first we have the market multiples. So I've compared the price to book ratio for the five largest Canadian banks, RBC, TD, CIBC, Scotia, and National Bank. I've compared price to book, price to net interest income, and price to earnings. And all the ratios give an average price of 137.38 per share compared to the actual price of $120 per share, which I think is actually pretty low. but I think this also reflects the fact that the entire banking sector right now is trading at a discount because of the increased risk aversion. Essentially, the crisis has increased risk aversion for investors, so it's also increased their required returns, and as a result, it's decreased the prices in the entire sector. But I think that this is only temporary. I've also completed a dividend discount model to represent banks. So this is traditionally a dividend discount model is going to be the best way to value a bank because cash flows are notoriously difficult to estimate for a bank. So if you think about it, when you do a DCF, you really only the best way to factor in the earnings is to subtract the capital expenditure and subtract the change in net working capital. But for a bank, those two elements are really hard to predict. And so dividends actually give you a pretty good idea of the cash flow because banks also typically pay out a large dividend. But the caveat is that this assumes that dividends are reasonable and sustainable, meaning that you assume that management is being reasonable with the dividends they pay out and that regulators do a good job of keeping banks in check in terms of risk taking and that everything that they do is sustainable. And we've seen that everyone who operated under these assumptions in 2008 suffered large losses. So my dividend discount model gives a valuation of $163 per share, but I don't give it too much weight because of these assumptions. I think these assumptions are sort of utopic. Um, and I actually adjust them to $138 per share given a 15% public market discount, which is a traditional number between 10 and 20% for a lot of analyst report that you read out there. My key assumptions for the dividend discount model is that earnings will decrease by 35% next year due to the increase in interest rates and will grow 10% in 2024 and then 7.12% thereafter. I base that on a multiplication between the average return on equity of 0.13 we've seen earlier and the retention ratio, which is 1 minus the dividend payout, which is ideally 45% for BMO, as we've seen historically prior to COVID. And I also use a terminal growth of 1.5 times the average Canadian GDP, which gives me a 4.65% annual growth. Next, though, is my discounted cash flow. So I've modified a discounted cash flow, basically using Tier 1 capital requirements as my proxy for the change in working capital. So this is sort of easy to do with BMO because we know that they want to be the market leader in terms of risk management. Right now, this means having a Tier 1 capital ratio of 18.4%, which is much higher than most American banks and slightly higher than other Canadian banks. But I maintain that this should be sufficient for BMO to maintain its title as the safest bank in Canada. And so I project that they maintain the same level of capital ratio over the years. And this gives me a valuation of $157 per share if I use a growth rate of 1.5 times, or actually double the inflation rate for my assets and my equity, and 1.5 times desired inflation for terminal growth. So using the capital ratio as my change, subtracting my change in capital, subtracting the change in Tier 1 capital to my actual net income that I project for BMO, I can get the free cash flow to equity. So my best case scenario is that capital requirements remain the same. There's no change in policy for banks around the world, even despite the banking crisis. This gives me a valuation of $157 per share. My worst case scenario is we would see a increase of 2% in capital requirements. So the government is tired of bailing banks out and sees them as unsafe right now. Banks have taken on too much risk and now they need to increase their capital requirements. For BMO, which is already way higher than the normal required capital by Basel III, this does not affect them much, but because they want to remain the market leader in terms of Tier 1 capital ratio, they also follow the market and increase by 2%. This gives a valuation of $141 per share. given the same assumptions for growth for assets, risk-weighted assets, and equity. So all in all, I recommend a buy for BMO with a price target of $149. This is the average of my bear and bull case that I presented earlier. But I don't think investors should honestly give too much weight to specific price targets. I just think the idea behind why this stock is undervalued right now is much more interesting. And you should just follow the story to determine whether or not you believe this stock is undervalued. So the idea is that investors in the financial sector suffered a trust shock as a result of the banking crisis. They're more risk averse, they've increased their required returns, and this has decreased the price for bank stocks. So right now, the questions that a prospective investor should ask themselves is whether or not banks, specifically BMO, are less safe than they used to be a month ago, and whether their true long-term potential for earnings has been affected by the failure of those mid-market US banks. So my theory is that this is not the case, and providing the market is right now providing prospective investors with an opportunity to capitalize on an inefficiency. So thank you for listening. I look forward to reading your comments.